Welcome to Liberty.me Live. I'm Albert Liu, and I'm joined today by Rick Rule. He is the founder of Global Companies, the president of Sprott U.S. Holdings, and a recognized expert in natural resource investing. Rick, it's great to see you again. How are you?
Great to be here, part two. Great.
I'm looking forward to a very interesting discussion with you today, and I invite everyone watching live to participate through the chat window here. Please send your questions over, and we'll do our best to incorporate them all. You can help by sending your questions in a way that relates to the discussion we're having. We're going to start by discussing the economy at large and then move to, Rick, your specialty, which is natural resource investing, and then move on from there to a wider or broader discussion on value investing. I wanted to start, first of all, by discussing the economy in general, particularly the zero-rate environment that we're in now, and how it relates to asset prices. And Rick, I was wondering if you could just start by talking about why we have this environment. Why are some people willing to pay more than effectively the face value of a bond to get less back than they pay up front? And what effect is that having on prices of assets?
Well, again, working backwards, the very, very low interest rates that we're experiencing now obviously inflates asset prices, both by way of making capital cheaper and by way of forcing people to take lower dividend yields. As to why people are willing to accept this, I think there's two broad reasons. One, the official sector, the government sector, has deliberately manipulated interest rates lower. They have done this partly because of their own excessive debt levels, in other words, to lower the debt level, the debt service requirements that governments have to reflate the global financial community, which obviously took a huge capital hit in 2008, but also because low interest rates are popular with lots and lots of people. I had the privilege, I guess, of attending a lecture by Dr. Allin in October, where he famously said that a strong dollar is inconsistent with a representative democracy because most people in democracy are spenders, not savers. High interest rates, high real returns on capital favor savers, not spenders, and low interest rates favor the spenders. And so he said that the sort of situation that we're in right now is what we could expect if society could get away with it. More important question, I guess, is where do we go from here? Because clearly accepting a negative real yield is problematic over a period of time. There are large investors that are accepting negative real yields because their perception of the risk in the environment that they're in. Better to lose 0.5% on a bond than lose 20% in the equities markets. Those investors are afraid that if interest rates go up, that the equity markets, which are unusually high, partially as a consequence of low interest rates, would decline, and that they may lose 20%. And by the way, I'm talking to you from Singapore, where I've been speaking at a mining conference and then doing 2 days of discussions with large investors. And I would say that they were sort of equally split with regards to the bonds. Some of them are investing in bonds because of fear. Others are beginning to boycott the bonds and being forced into equities simply because the yields that they're getting on the bonds are so low. But you know, historically, the high-quality bond investment has been the province of sovereign wealth funds, superannuation funds, and retirement funds. And one of the interesting circumstances that this negative real yield environment confronts us with will be greater underfunding of the pension liabilities of things like the Social Security system or the National Pension Service of Korea, places like that. So the question that you ask is a vast question. I apologize for the rambling nature of the response, but it requires a sort of a nuanced answer.
It seems like the winners in this scenario are the sovereign borrowers, And the biggest savers, people that stand to lose the most, would be seniors, people who have saved all their lives and invested in bonds, and as you mentioned, these pension funds. Now, you'd mentioned once in a conversation that this environment is, in a way, chasing capital away from private markets. And you would think that that would have serious repercussions, actually, on the endeavors of people who are trying to raise capital at the prices of these assets, and possibly for speculators looking for an opportunity to deploy capital.
Well, that's quite true. The private banking sector changed dramatically with the implementation of the Basel III banking protocols, which changed the nature and the character of the reserve requirements impacting the biggest banks in the world. And I won't bore you with chapter and verse, but suffice it to say that the biggest banks worldwide aren't required to maintain any reserves at all on sovereign obligations that are to be held to maturity that are denominated in the currency that the bank is domiciled in. So, as an example, if we had a European bank called the Bank of Albert, and the Bank of Albert bought $1 million bond denominated in euros, and the Bank of Albert was domiciled in a Eurozone country, if the bank bought $1 million Greek bond that was denominated in euros and was trading in the market at 70 cents on the dollar, the bank could hold it in its reserves at par, that is, at full price, irrespective of the market discount, because they purported to holding it to maturity. And they also wouldn't need any equity reserves against that dollar of debt. Conversely, if the Bank of Albert lent $1 million on a senior tranche of a project development loan to somebody like BHP or Rio Tinto, a credit-worthy borrower, the bank would be required to have equity and Tier 1 capital reserves against that debt. And if any of the debt was recorded trading at a discount, the bank would be required to impair or risk that loan. In addition, if the banking examiners, European banking examiners, came into the Bank of Albert and noticed a concentration on mining or resource loans, or a concentration on private sector loans to the region of the world that that loan had been made in, the banking examiners could put in place further reserve requirements, limiting the amount of leverage that the bank would employ and making that loan less and less profitable. Pardon me. The consequence of that has been to drive more of the bank's assets into sovereign debt instruments and less of the assets towards private sector lending. Now, ironically, one of the beneficiaries of this is myself and Sprott Inc. 5 years ago, it was impossible for us to participate in the A tranches, the senior tranches in natural resource lending, because the larger banks had lower cost of capital and have lower cost of capital and simply could outcompete us. It's ironic to see interest rates falling over 4 years and see the interest rates being paid on the senior tranche of mining and oil and gas loans going up by 30 or 40%. From our point of view, I guess it's a very strange, but a very pleasant circumstance. And I guess it goes to the fact that the implications of these broad strategies are numerous and confusing, and investors who attempt to fashion a one-size-fits-all response to these big questions tread on very, very shaky ground.
Now, governments are, in a way, they're notorious for creating these enormous dislocations in the markets and creating opportunities for speculators like you. And it seems like this is one of those opportunities. I've heard similar conditions exist in other markets as well. I think real estate is one of them, where the banks exiting has just created a vacuum of opportunity. So let's move on to small cap resource stocks, which is your specialty. And I'd like to know, just personally, where do you stand, or where do you see this market right now? You have been on the sidelines. Is now the time to jump in? What exactly are you seeing right now?
We're attempting not to be on the sidelines, with the caveat that we're attempting to enter the market via private placement. We're attempting, rather than to buy issues in the broader publicly trading market, to acquire our positions by making placements directly into company treasuries and ending up with warrants. And the fact that I am about 40% cash in the appropriate junior mining accounts isn't so much a signal of my unwillingness to be in the market, but rather a signal of the issuer's unwillingness to issue capital at equity prices that they believe are severely depressed. Now, with regards to the market in general and other participants in the market, I would say that this market has bottomed, but I would say that it bottomed without either an investor capitulation, a rapid sell-off, or an issuer capitulation. And the consequence of the fact that we didn't have a capitulation, I think, is that the recovery is going to be very saucer-shaped, very shallow. You will and have seen this year higher highs and higher lows, but you have and will see volatility, 15, 20% swings in the market as a whole and in individual issues that will, of course, alternatively terrorize and delight speculators. And I would suspect that this gradual recovery could take 12 to 18 months more before a recovery gets underway in earnest. A long-winded answer, but I'm afraid I have to prolong it. Albert, you and I have talked before about bifurcation, which is the process by which the best juniors begin to pull away from the pack. And we have definitely seen that. The top 15 or 20% of the issuers have caught bids, been able to get financed when they needed to, and are doing quite well. This isn't apparent in the index, and it isn't apparent in many investors' portfolios that don't have the skill to do the qualitative differentiation or stock selection, because 60 or 70% of the listed junior miners probably are valueless, and they're attempting to go to their intrinsic value, which is at zero, weighting down the whole index at the same time that their better brethren are beginning to do quite well.
Is it your suspicion that this is exactly how the recovery is going to play out, meaning there isn't going to be capitulation? Because you mentioned a very long saucer type recovery. Is it your guess that that's what we're going to have? We're not going to see it in this cycle at all?
I think the valuations are such that I'm constructive to a recovery without capitulation. That being said, I've never in my life seen a bear market in junior resources end without capitulation. It bears saying that if we had a dramatic event in equities markets, an event of the type that we had in October of 1987, or an event of the type that we had in 2008, our listeners would find out to their dismay that gold stocks are stocks. And in a broad equity sell-off, at least initially, the peripheral assets like junior mining shares would sell off too. So it's not impossible to believe that in the midst of this recovery, we could have capitulation that was not of our own market's making, but rather as a consequence of the broader market. That would set the stage after some initial terror for a very, very strong recovery. At least that's what's happened in the past.
Have a question from Malik, who is part of the San Jose Investors Group, and he's talking about valuing resource companies, and he asks if you're going to invest in, let's say, a mining company, you must have an underlying opinion or an implicit opinion of the direction that the commodity price is going to go. Is that true? And how do you arrive at such an opinion, since commodities, like take gold for example, it doesn't have earnings, so it's a difficult thing to discount to present value, as a value investor. How do you take that into account?
Well, I think it depends really on the nature of the company that you're investing or speculating in. Many junior mining investors are speculating more in the discovery or the development of a commodity than they are in its production. And I caution those investors in the junior mining shares where they're looking for gold, as an example, that if the price of something that you have none of goes up, it shouldn't have an important underlying valuation determinant in the company. If the company that you're involved in is looking for gold but doesn't have any gold and the gold price goes up, it doesn't do much in terms of intrinsic valuation. The second thing I would say is that in the early stage ventures, in the juniors, the direction of the commodity is something that you ought to get for free in the company. You ought to invest or speculate in junior mining companies because of their success relative to their peers. If you believe that the gold price is going to go up, but you aren't willing to do the fundamental work in securities analysis to determine better companies from worse companies, I would suggest that you buy gold in anticipation of the gold price going up. You take the additional operating risk in an equity because you think that the equity in question is going to do well relative to its peers. In terms of gold price forecasting, of course I do that. But in terms of company valuations, rather than superimpose my own guess as to what level the gold price is going to reach, I use the forward strip in commodities, the futures prices in commodities, to make my price determinations that I would use in my net present value calculations. I should also say, since you gave me an opening with that question, that most gold analysts around the world, most mining analysts around the world, come from sell-side institutions. They come from brokerages. And most of the brokerages have a built-in bias to get you to buy things. That's how they earn their fees. And the consequence of that is that the assumptions that they use in their valuations are mostly very aggressive. I have seen discount rates on projected future cash flows of 0 or 5%, which is a very interesting discount rate because the borrowing costs of these companies, never mind the equity cost, the borrowing costs of these companies, creditworthy companies on good projects, is in the 9.5% range. So unlike my brokerage industry fellows, I almost always use a 10% discount rate on future net cash flows in establishing risk-adjusted net present values, a discount rate that's higher than virtually every brokerage firm in the world.
Okay, now having said that, the importance of a company's performance versus its peers, you said you should get the upside for free. And so basically what you're saying is you wouldn't hesitate investing in one of these companies even with a flat commodity price. But what about a declining commodity price? Would that cause you to exit the space?
Obviously, the deposit has to be extremely attractive relative to its peers. And I need to believe that the net present value of the net present value of the deposit, even at lower commodity prices, is going to be attractive. One of the things that I think sets me apart from many other speculators, to my benefit in some markets and to my detriment in others, is that having been in resource businesses for 40 years, I understand that being right in a small company can involve a 4-year or a 5-year or a 6-year hold. Many competing speculators, I suspect because they confuse what they wish for with what ought to be true, have trouble holding stock over a long weekend. And for those speculators, the perception of the broad market is probably more important than the reality of the issue. I'm not in the game to buy a 20-cent stock that goes to 30 cents, although that can be pleasant. I'm in the game to buy a 20-cent stock, get a full warrant, and see the thing go to $2.50 or $3. So my time frames are different, and the whole nature of what I do is substantially different. As an example, I'm perfectly willing to believe right now that the uranium price or the met coal price, metallurgical coal price, could go lower. But if I had the ability to buy a high-quality met coal asset in a place like Pennsylvania or a place like Germany that had shipping advantages or product advantages, and I had the opportunity to do that at an extraordinary discount, I might do it anyway, even in anticipation of lower coal prices. A classic example of this is the recent investment by Sprott in Corsa Coal in Pennsylvania, where we knew the coal price was going to go lower. These are assets we know well. We bought these assets probably, I don't know, 8, 9 years ago. And if my memory serves me correctly, we paid about $70 million for them. We spent to $25 or $30 million upgrading them. And we had the extraordinary good fortune in the last coal cycle to sell them to Seversol, a Russian steel maker, for $1 billion. The Russians then spent $280 million on them, so they had, I don't know, almost $1.3 billion. And when the coal price collapsed and Seversol began to pull out of the U.S. steel market, they sold those assets back to us for $60 million. They had $1.3 billion in them. They sold them to us for $60 million. It is likely that we're going to have to suffer through 2 or 3 bad years with those met coal assets, but we bought them because they're high quality, low-cost assets, and we know that it is and always has been cheaper to ship coal from Pennsylvania to Pennsylvania than competing coal from someplace like Indonesia or Australia to Pennsylvania. So because of the extraordinary quality of the asset and because of the really extraordinary price that we paid for it, we're willing to take 2 or 3 years of pain to get what we hope will be tenfold gain.
And another question coming in about valuing gold companies or mining companies in general. What are the most important considerations? P&P reserves, costs, commodity price, which we've already discussed. P&P, I assume he's referring to proven and probable.
Proven and probable.
How do these factor in?
There isn't a one-size-fits-all answer to that. What is important, I think, is to look at 3 things. Look first in a small company at the quality of the management team. Look at the level of participation that they have in the company. In other words, you want to be involved with a management team that are owners, not professional managers. Look at experience that's directly related to the task at hand. If the gold deposit is an oxidized deposit at high altitudes in the Andes, look at a management team that has had technical success in that type of deposit in the past. If you have a competent management team, of course, look at the asset and look at the viability of the asset in this price environment and in these capital markets environments. But what's particularly important with regards to speculating in a small company is look for the catalyst. Look for the unanswered question. You make money in sub-billion-dollar market cap companies from their progression. And so it's important that irrespective of the company that you're speculating in, when you determine that it's undervalued, ask, and secondly, what's going to cause it to become less undervalued. If you can't identify the problem that is keeping the company from coming to the attention of the market, in other words, if you can't understand why the undervaluation exists, you don't know enough about the company to make the investment, because the fact that it's undervalued tells you that there's a reason for it. So you need to determine that, and you need to determine the risk associated with it. And then secondly, you need to find out what the unanswered question to unlock the value is. And you need to assess the probability that the company will be able to successfully address that question, and the value that will be unlocked as a consequence of the yes answer. Again, that's a long-winded answer, but the truth is that the process by which one succeeds in sub-billion-dollar microcap resource development is very much a process of answering a series of unanswered questions.
If the answer was easy and short, we wouldn't be having this chat with you, so appreciate that.
Thank you,
To
Albert.
the listeners, if you want to send us a message through the chat window, I will pick it up and ask Rick. Rick, in your experience, what percentage of companies out there fit the description of the type of company that you are looking for, meaning qualified, proven management team with directly related experience and so forth? What percentage of the issuers out there meet that requirement?
Certainly less than 20%. At Sprott, we believe that the number of public junior issuers on a global basis is around 300. I'm talking about mining and oil and gas. And we believe that we can cover a representative sample of the best of them by following 200 companies worldwide. So that's less than 10%. It's a certainty that following less than 10% of the issuers worldwide means that we're going to miss some. But the truth is it's uneconomic for an institution of almost any size to follow 600 issuers on a global basis. I would tell your listeners from practical experience that following fewer companies more closely is much better than following more companies broadly.
Okay. Now, in terms of the viability of the company and its reserves, when you're looking at costs, do you place more importance on the sort of the cash analysis or what they're calling the all-in sustaining requirement?
Certainly the latter. All-in sustaining capital costs are critically important. In development stage companies, of course, the cash costs are important because the first question is, can they raise the money to put the project into operation? If you are talking about a more senior company, well, as an example, a tier 1 producer, then all-in sustaining capital cost becomes much more important. If you are talking about a junior company, however, the valuation becomes as much art as science. It's called risk-adjusted net present value. In other words, you arrive at a net present value calculation that takes into account a lot of imprecise assumptions. What will the total capital cost be? What will the cost of capital be? What slice of equity will be required in project finance, and how much dilution will result as a consequence of that? What will happen to construction and development costs over the next 3 years? How will changes in interest rates reflect revolving credit facilities? How will changes in currencies impact costs? And how will energy prices impact them in the future? The truth is that you aren't going to get precise answers. You're going to get a range of answers. And if you aren't comfortable with the range of answers, you need to find another sector. The great news is that this very complexity chases away some speculators who would otherwise be viable competition for you. One more thing with regards to all-in sustaining costs, Albert, while it's fresh on my mind, the heading all-in sustaining capital cost, all-in sustaining costs sounds like an all-encompassing phrase. But the truth is that there's some fraud hidden in the phrase, because the all-in sustaining costs that are being reported by public companies now usually do not include prior write-downs. So an industry which has taken $30 billion in write-downs in 15 years is reporting all-in sustaining costs without taking into account the depreciation depletion charges that would have resulted from the shareholders' money that they sent to money heaven due to the charges that they've taken. It's important to note that when the industry talks about all-in sustaining costs in the $1,100 range, that they're probably leaving $250 per ounce in sunk costs out of the equation. And investors need to look back at prior years' financials and add back the costs from write-downs that the management team has taken. Very important to do that.
What percentage of these gold producers would you say then are viable at today's price, near between 11 and 1200 per ounce?
I would suggest that if the 11 or $1,200 per ounce number were to last for 5 years, and if the interest rate was to go up 200 basis points, that the industry as a whole would be unviable.
I'm going to take one more question before we move on to the next topic, and that is, how does the grade of the reserves factor into your analysis?
Well, grade is certainly important, but remember that not all grade is created equal. A high-grade deposit that has challenging metallurgy, or a high-grade deposit that's very deep, may mean that despite the fact that the grade is very attractive, the economics are very unattractive. In contrast to that, a low-grade oxidized deposit in the right set of circumstances can be extremely profitable. I remember the early days of Glamis Gold, where they operated a surface oxide deposit in southeastern California with extremely low grade, well less than a gram per ton. But it was an extremely profitable operation. The stripping ratio was effectively nil. The deposit outcropped on surface. The weather conditions were perfect. The rock was so completely oxidized that irrigating the rock with water and dilute iodine solution took the gold out of solution and delivered it very nicely to the pregnant pond. So an extremely low-grade deposit was operationally efficient and had very low upfront capital expenditures. So again, there's no one-size-fits-all question. What I would say to your listeners with regards to grade, with regards to valuation, is that I try and concentrate on projects that are in the top quartile worldwide in terms of both capital efficiency and cost. In other words, I would rather have an efficient operation than a leveraged operation. Most of my competitors look for precious metal stocks that exhibit one defining characteristic, which is leverage to higher metals prices. And ironically, of course, the most leveraged producers are the most marginal producers. And that implies substantial risk if the metals prices take a move in a direction that you hadn't anticipated. So for myself, I've noticed that I get all the upside I need without buying leveraged producers. And so I try and buy top quartile producers and top quartile deposits, focusing on efficiency rather than leverage.
You said, I've heard you say that the market actually demanded this leverage and the industry was very happy to comply. I have
Albert,
a question.
Go ahead.
I have a question coming in from Maurice, and he asks, have you noticed any significant changes in the ratios of the stock float in the industry?
I anticipate what he is asking me when he says float is, have there been a lot of issuances? In other words, are companies issuing a lot of equity? And the answer to that so far is no. And I see that as a fairly valuable sign. One of the things that was astonishing to me is in the beginning part of the last decade, when the gold price advanced from $250 an ounce to $1,900 per ounce, a more than six-fold increase, of course, in the gold price, is that per-share cash flows in the industry actually declined. The gold mining industry raised and wasted so much money that despite a 6 or 7-fold increase in the selling price for gold, per-share cash flows in the industry declined. So the new capital efficiency that we're seeing, at least right now, companies like Franco-Nevada, companies like Rand Gold, companies like Goldcorp, in fact, that are focusing more on the efficiency of their operations than the size of their operations, is a very welcome change indeed. And I hope we continue to see that. The other thing that Maurice might have been referring to, he and I talk fairly frequently, is the fact that in the smaller gold mining companies, more and more of the stock is owned by fewer and fewer people. you might see a company with 100 million shares outstanding that used to have 80 million shares very broadly held by weak institutions and by individual investors who really didn't know very much about the company that they owned. That same company today may have 15 shareholders, old veterans like myself, that control 85% of the float. The important thing about that is that when the free trading float is used up and concentrated and is controlled by long-term holders, the up moves in those stocks can be really, truly dramatic. I remember with some fondness 2002, 2003, when the process of consolidating the last bear market had taken place. And rather than having buyer exhaustion, we had seller exhaustion. And these shares literally melted up. There were portfolios that increased by 200% in a year as a consequence of 7 or 8 issuers having had their free trading floats used up by sophisticated longer-term investors. And I suspect that that'll happen again this time. So I'm not sure what aspect of float Maurice was asking me about, but I hope I exhausted any questions he had.
I think you did. He may have been referring to the Treasury, but perhaps also to like you said, well-heeled investors as well. I got another question here. In the past, you've emphasized the importance of scrutinizing a firm's financial statements to get the important information. What confidence do you have that you're getting, for instance, accurate cost information in these statements? Can you put your full trust in these?
Full trust, no. But the reporting has gotten so much better in the last 20 years. Now, I have to say at Sprott we have an advantage that your listeners and readers don't have, in that in addition, we use the financials more as a screening tool, and if we can't find any other reason to dislike a company, in other words, if the financials have survived all of our screening, we always send somebody to the operation physically. In other words, in the words of Reagan, we trust, but we verify. But the truth is that so few people scrutinize the financials at all that you can outcompete your fellow investor fairly well simply by taking the time and trouble to look at the financials. And the more of this you do, the better you get at it. One thing that you'll notice as an example by scrutinizing financials is that if you use some of the simple techniques that I taught in the Shark Tank series at Liberty.me, which has to do with looking at general and administrative expense as a percentage of total expenditures. Of course, lower G&A charges are better than higher G&A charges. What you learn as you get better at pawing through companies' financials is that these companies are very good at putting some of the general and administrative expense down below the line in project expenditures. The company's president may pay himself or herself $250,000 to run the company, but then may also be employed as a contract geologist or a consultant at the project level and may be taking another $10,000 or $15,000 a month out in what is really G&A at the project level. One of the things that happens is that although the financials don't change too much over time, your ability to get at the truth in the financials, your ability to begin to understand the reporting vagaries get better and better and better. And that's very important, because the truth is that you're never going to get it absolutely right. You have to get it more right than your competition does.
We have a saying in engineering, Rick, that summarizes, I think, your feelings on that. It goes something like, in God we trust, all others bring data.
And then, of course, the engineer has to be well enough educated to understand the importance of the data.
Exactly, exactly. I've actually wondered at times about the benefit of sort of site visits and stuff. You have, for instance, someone who may be covering, mining stocks as a newsletter. Is there a lot of benefit to, essentially a lay person, even someone who is familiar with the field but not a geologist per se, what benefit is there in these site visits? Do you go see these sites in person?
I went on site visits personally for years, and I found them to be invaluable.
Oh,
Within the Sprott organization, the overall Sprott performance is better driven now by my doing things that are more suited to my capabilities within the organization. We have in the Sprott US organization two outstanding geologists, Andy Jackson and Neil Adshed, and they are technically capable of doing most aspects of a site visit better than I, but they have also learned enough commercially that some of the other aspects of a site visit they're very competent at too. I can give you a very simple example of the virtues of a site visit. I remember very well doing a tour of the northern Nevada operations of both Newmont and Barrick 20 years ago. And you didn't have to be a geologist to notice that the Barrick operations were sparkling clean, that the employees were highly motivated, were moving around, were well run. It looked in fast food parlance like an extraordinarily well-run McDonald's. Hamburgers flying out of the place, and the place absolutely sparkling clean. Newmont at that point of time, by contrast, was trash strewn. The employees were sullen and slovenly, and it was reflected in the operating costs in both organizations. One didn't need to do anything with regards to ascertaining tonnage, grade, or exploration upside. One merely had to compare and contrast the operating management style in both operations to come home with an opinion that you would later use to explain an income statement. Another classic example, and I actually forget the name of the mine, but I went to see an open pit operation, and it was very clear to me that one of the pit walls was unstable. And you could see this from the rim. This was not anything that the management team had issued any sort of press releases about, but it was enough to allow us to avoid the stock. And it wasn't 6 or 7 weeks later that they had a fairly massive landslide at that operation, which shut down their production for 8 or 9 months. So in that particular regard, that was a dramatic reminder of the necessity for site visits.
a couple more questions coming in for you, Rick. Again, from Maurice. Is there any circumstance under which you would accept a G&A above 30%?
Absolutely. There are circumstances where the progress of the company has more to do with G&A than it does to do with exploration. An example would be a prospect generator moving into a new jurisdiction, in particular a challenging jurisdiction. Let's say Bolivia or Indonesia or Congo. Temporarily high general and administrative expenditures that have to do with broad-based technical surveys, that have to do with the legal and social license to operate in a country. If the reason for the general and administrative expense is well communicated by the company to the investment community, and the investor takes the level of general and administrative expense into the context of answering the unanswered question, there are circumstances where G&A at 80% is acceptable. It may be that the unanswered question in an early stage company is that they have identified broad geologic potential in a frontier area, and the unanswered question is, will they be able to stake the geological concept, and will they obtain the social and political license? A company that I'm involved in right now is engaged in just such an activity in the far western reaches of the Democratic Republic of the Congo. I'm not going to disclose the company because I don't want your listeners competing with me in the name. But in that sort of circumstances, the unanswered question is, will the Congolese government allow us to access the land that we believe has the potential to harbor an important mineral deposit? And all of those questions, the data acquisition questions, the land acquisition questions, and the political and social license, all come under general administrative expense. The more problematic circumstance, of course, is the zombie junior, which has already done all of that kind of stuff and is spending $1 million a year, and 700,000 of it goes to keeping the company solvent, and 300,000 comes to the prosecution of the asset. That's a very different circumstance.
Rick, I'll let you give me that the name of the stock offline. Just kidding. In a previous lecture, you've mentioned the importance of spending on sales and marketing, actually, which is related to this discussion, that proper allocation to sales and marketing is essential to reduce the cost of capital going forward, and that's something that makes you feel good as an owner.
Sorry, I couldn't hear the last part.
And I was saying that it's important to have an adequate sales and marketing budget that will allow you to reduce your cost of capital in later stages.
Promotion is absolutely critical. One of the things that we must remember with junior companies is that most of them have no free cash flow. So in a capital-intensive business, no capital means no business. And lowering your cost of capital means marketing and getting your message out. The promotional budget and the promotional program results in absolutely incredible misallocations of capital many times, particularly in periods where the capital markets have been generous, like the period that we went through in the sort of 2004 to 2011 timeframe. Promotion becomes very misguided and very haphazard. And capital acquisition is probably the most important task that the CEO faces in a small company. So in addition to having a reasonable budget, the company has to have a good promotional plan. What is the message? Who is the audience? Is the audience appropriate to the message? How do you reach that message? How do you continue to convey that message? How do you differentiate yourself from other messengers with other messages to the same audience? Most of the time when I ask companies to detail to me their capital acquisition plan, I find out, in fact, that they have no plan. The idea is to issue a few press releases, effectively shoveling a bunch of manure and seeing what sticks to the wall. In the absence of a plan, they actually make my life very easy because I sell the stock.
Okay. This is the last question on resource investing, and then we're going to move on. When you're investing in these different regions, they all possess or entail some political risk. How do you assess this political risk? It's a question from Michael.
Very important question. And the truth is that the answer to it is very different than what your listeners will understand. Talking to an audience at Liberty.me frees me from the necessity of explaining to the listeners that for resource industries, and probably all industries, governments are just pernicious. That's all they are. But most of us fear psychologically risks that we don't understand. And the perception of political risk in extractive industries is mostly wrong. We believe, when I say we, I mean North Americans believe, particularly North Americans who look like me, that resources that are stolen from you by white people in English, according to the rule of law, are somehow less gone than when they're stolen from you in Latin America or Asia or Africa. And that's in fact not true. I say with absolute certainty that my worst experience with political risk occurred in the PRC, but not the PRC that you think of. I'm talking about the People's Republic of California, where an enormous amount of money was stolen from me through the political process completely legally by the legislature. The truth is, and again, there's no hard and fast answer to this, but the truth is that countries that can't get much better, societies that can't get much better, don't get better. They get worse. The tendency towards redistribution of wealth that has been created, once wealth does get created, means that governments become more and more and more pernicious. And mining seldom finds political favor in countries and societies that don't require it for their well-being. What that means is that countries that have established mining climates generally deteriorate rather than improve. By contrast, countries that can't possibly get much worse, countries that are total wrecks, first of all, have very low cost to admission, and generally, as a rule, get better, not maybe in the time that we hoped they would, but certainly over time. I remember very well in the 1970s, Chile was absolutely a no-go area. They went through the socialist regime of Salvador Allende, which was absolutely amazing. One of the best agricultural economies in the world, couldn't feed itself. And they went from there to Pinochet, who dealt with political opponents by taking them for a plane ride, which was abruptly ended by throwing them out of the plane. It was not regarded as a great place to invest. But the truth is that Chile had a lot of copper, and Chile understood that they needed mining to put the country back in place. Now, Chile is recognized by the Fraser Institute as the top mining jurisdiction in the world. But the truth is that Chile, now that it has everybody's favor, is getting worse. The taxes are going up. The regulations are becoming more complex, but ironically, less well enforced. And the forces of redistribution are alive and well in Chile. So the truth is, in the late 1970s, when Chile was on everybody's no-go list, it was actually the best jurisdiction on the planet. Now that Chile is regarded as the best jurisdiction on the planet, it gets worse every quarter. Political risk, like every other risk that we've discussed today, is nuanced. It's a matrix.
Very interesting. Hence, the advantage is to the contrarian once again.
Correct.
I want to move on to value investing in general. This is a question that I really want to ask you. Is if I compare and contrast your career and your style with that of Warren Buffett, who is also a very famous value investor, one thing I notice is that both of you like to avoid areas, certain areas that you're not comfortable with. But he seems to have gone into many more areas. I mean, he has financials, he's in insurance, a wide variety of styles, whereas you focused primarily in the resource sector. And I'm wondering, I'm sure if I ask you why you haven't branched out, you'll say something like there hasn't been a need, meaning this sector has offered you plentiful opportunities, and you like to pick fights that you can win. But let's say that for some reason you had to branch out, invest in different sectors, that this sector was off limits to you. What would prevent you from excelling the way you do now, and how long would it take you to acquire the necessary skills, contacts, whatever it is, to excel in some other field the way that you do now?
Well, in truth, Albert, when I was a young man, I enjoyed extraordinary success in the resource industry, confusing a bull market with brains. And in addition to being disabused of my skills in the resource industry, I attempted to branch out from resources to other sectors, believing myself to be a truly superior businessman in all regards. I came to be disabused of that knowledge pretty thoroughly. In other words, I endured a really savage spanking. I now have 4 decades of experience in the resource sector, so I have a competitive advantage over many people that have been less specialized. I also have a very, very deep Rolodex in natural resources. So in addition to knowing how, I know who. One of the differences between, well, there's 2 primary differences, I guess, between Buffett and myself. The first is that he's smarter than I am. I acknowledge that. And he has the ability to understand more industries than I do. The second is that the challenge before us is different. At Sprott, we have to attempt to earn above market returns on about $8 billion in assets under management. And we have a constituency which, while they don't, how would I say, welcome it, have come to understand both volatility and cyclicality. Mr. Buffett's challenge is very different. He has to manage about $400 billion. And the idea that he could manage $400 billion in one sector, particularly a volatile sector and a capital-intensive sector, is different. Now, Mr. Buffett very recently has come to understand that his reputation has given him access to a low cost of capital, and that he has a durable competitive advantage in capital-intensive businesses. This is an understanding which has come to him only in the last 6 or 7 years. And the consequence of that is that Mr. Buffett has suddenly become an oil industry investor, an infrastructure investor, and a utility investor. I think this is extremely unfortunate because I enjoyed not competing with him much more than I think I'm going to enjoy competing with him. Moving forward, as I age and as my effective career in natural resources begins to be shorter, I will certainly return to some of my deep value roots. In other words, I will seek to invest in, and I am seeking to invest in now, sub-$100 million micro market cap companies in very mundane industries, principally the Ben Graham style stocks, where I'm buying companies that are selling at a discount to net working capital that are cash flow positive. I call these free bonds, where you're getting the business for free, and although the business isn't a growth business, it is making money. It's generating cash with no enterprise value. I'm attracted to that. And the second thing that I'll do is I will invest in the financial services sector. I have 40 years of experience in the financial services and investment sector. I've been part of starting 6 banks. I've operated brokerage businesses. I've operated money management businesses. And I'm probably the world's only insurance wannabe. In other words, I studied the insurance industry as an avocation. So I would say outside the natural resources businesses, the most appropriate place for me to be an investor will be in the financial services sector because I understand it.
Okay, we're coming to the end of this discussion, but I want to ask you about something that pertains to the individual investor. In the course you gave on investing some time ago, you referred to an asset allocation, which you called the portfolio pyramid. It consisted of 4 different asset classes. A base you called insurance, a core, growth, and a speculative component, 4 components. I'm wondering, is this still your core philosophy in terms of individual investing?
Albert, I have to congratulate you as a researcher, first of all. I authored that paper probably 20 years ago, and the fact that you managed to find it in the bowels of the global website tells me that you're a very diligent researcher. And in truth, the portfolio pyramid, as I called it in the lectures that I gave in those days, remains the sort of centerpiece of the lectures that I give individual investors with regards to how to manage their wealth and, in fact, how I manage my own wealth. The core or base that you describe is what I would call insurance. It is the money that allows you and your family to sustain themselves in any set of circumstances. The assets which populate that for me are largely cash, cash equivalents, and bullion. The sort of next level up, it involves very, very high quality assets. This might be your personal residence. It might be timberland that's fairly unleveraged. It might be very high quality farmland, either operated by yourself or with long-term high quality tenants. It might be very high quality commercial real estate with only moderate leverage. It might be an ETF like the Noble ETF with very stable companies that have raised dividends every year for 25 years, provided that you're willing to hold that portfolio for 15 or 20 years. The next level of the pyramid would be the classic growth stocks, where you're willing to take more risk, but you're still buying entities that you can value on a net present value basis. And the top of the pyramid, of course, is the speculation, where you're taking substantial risk to premium in terms of outsized gains. The most important part of the portfolio pyramid lecture was always to have people right-size the distribution of their assets in that portfolio, both in terms of their need and in terms of their expectations. So very wealthy people had to have less of their assets in the least risky categories, because we all have essentially the same survival needs. And wealthier people could afford to take much more speculative risk. What I ask people to do in terms of allocating capital through the four sectors is to understand the relationship between reward and risk. So at the very bottom of the pyramid, you may own assets like cash that you would expect to give you a 1% return. I ask people to always take a risk calculation that's 1.5 or 2 times the expected return. So it might be that in a portfolio, as an example of short-dated bonds, that you could experience a 1.5% decline in principal. Certainly with regards to my gold, the fluctuation in the valuation of my principal has been much greater than that. But since I haven't proposed to sell it year by year by year, I haven't been exposed to that risk. If you move up into very, very high quality assets that are moderately leveraged, it might be that your return expectation is 5% or 6% annually. And the consequence of that is that if you went into a 3 or 4 or 5 year bear market, it might be that rather than getting a 5 or 6% escalation, you could get a 5 or 6% decline for several years running. And it's important to make allocations to that sector based both on your appetite for reward and your tolerance for risk. Similarly, in the growth part of your portfolio, where you're buying pretty high quality companies, but you understand you're taking some principal risk, let's say that you're looking for a 15% compound internal rate of return in that part of your portfolio. I would ask you to be willing psychologically, for the amount of money that you put in that sector of the pyramid, to be willing to run a risk to principal of between 150 and 200% of your return expectation, i.e. 20 to 30% risk to principal. And at the tippy top of the pyramid, the speculation, where my own internal rate of return calculations are 35% compounded annually, I do that with money that I'm willing to risk a 50 to 70% loss of principal in. An achievement that I have actually experienced 3 or 4 times in my career.
Rick, I find this very interesting, and unfortunately we're running out of time. So what I'll do is I have some follow-up questions, which I'll mention now, but I invite people to follow this in perhaps a discussion group that we start within Liberty.me. And these are the questions that I'd like to ask you in this discussion group. One, it's very interesting that over the decades, your targets for each of these asset classes has not changed, meaning we have zero interest rate policies, we have QE, for example, yet you're still trying to get 1% real IRR over 5 years on your cash. Be interested to learn how you do that. It seems like trying to get that is more risky now. The other thing I want to ask you about is in the speculative section of the portfolio. It seems like if when you talk to experts like yourself, we all like to listen and learn. However, it seems like a lot of those techniques are not actually available to us. For example, when Mr. Buffett says, "Buy American, I am," if you were to call Bank of America and ask for the 10% preferred with a warrant, they hang up the phone, or I don't even get past the auto attendant. And so when you go in and you get an equity with a full warrant, it's not something that's available to everyone. And another example I have is Jim Chanos, the famous short investor, who come right out and say, retail investors should not sell short. It just doesn't make sense from a tax standpoint and other standpoints. So I'd like to ask you, and we can direct this to the forum, our discussion group later, is the only way for us to invest like you to actually invest with you?
I don't think that's true. I think the advantage of investing through me is that you're investing with a team of 160 investment professionals worldwide who only do this. But the truth is that an individual investor who is willing to be more or less a full-time speculator has some advantages that I don't have. Trying to generate returns on $8 billion is a lot more difficult than trying to generate returns on $1 million. And so the truth is that an individual investor managing his or her portfolio, albeit mostly full-time, has some advantages that I don't have. I was my most efficient as a trader when I was a university student. And I would take a $700 or $800 trading position with a very specific goal. It might have been 4 snow tires. It might have been 2 months' rent. And the truth is that during university, I consistently generated 100% returns on capital employed. The problem was I didn't employ very much capital. For most investors who don't have enough interest, who don't have the same passion that I have, and who have lives, for those investors, you probably are better off investing in partnership with me in some way, shape, or form. Take the level of service for me that's most appropriate to you. You determine that, of course, and allow the 160 people in this broad organization to assist you with as much assistance as is required. But it's very important at the same time that the investor, even if he or she elects to invest alongside of us, develops their own paradigm. If I'm managing your money, even as an agent, I'm working for you. And it's important for both you and I that I have a very good job description. And so it's important that the client participate as vigorously in that process as the manager.
Okay, Rick, we're going to have to wrap it up, but on behalf of myself and all of the viewers, I want to thank you for your time. And I recommend everyone go to the website that I've created for Sprott. That's powerandmarket.com/rule. And there you're going to find links to some of the material that I've mentioned on this interview, as well as a link to get on the mailing list for the Sprott newsletter, Sprott Thoughts. I also want to mention that we have a Sunday night show on Liberty.me Live with Jeffrey Tucker. It's the Liberty Classic series, and he's going to be discussing Conscious of an Anarchist. Also, if you're interested in downloading a free guide, Liberty.me guide on how to buy and sell and store precious metals, you can do so if you're a member. If you're not a member, you can sign up for a 1-month free trial and download this handy guide. Also on Monday, I believe we're going to have Lynn Albrecht on Liberty.me Live as well to discuss the developments in her son Ross's trial. So Rick, I want to thank you very much. It's been a pleasure as always.
Thank you, Albert. I enjoyed the questions, I enjoyed the process, and I enjoy your contributions to Liberty.me. Thank you.
Thank you very much, guys. This is Albert Liu. You can check me out at powerandmarket.com. And until next time, take care.